हाय स्टूडेंट, गुड डे। आज हम स्टार्ट कर रहे हैं चैप्टर 2 ACCA फाइनेंशियल अकाउंटिंग F1 चैप्टर 2 regulatory framework and bookkeeping. Actually, the 2 and 3 chapters are together. We'll continue. As previously you have watched over chapter 1, and in this chapter student will share you this slides of the book study text, and we will provide you a flashcard also for the chapter 2, so which will helpful for you to remember and memorize quickly and prepare for your exam very fast way. So you just spend uh, some time for memorization, some time for recall, some time for revision practice and exam questions. So will help you to go through all resources, and which will ensure your success definitely. So the framework is already the standard designed by in chapter 1 also. You see we have discussed, and here they have explained the main regulatory system and explain IFRS accounting standard कैसे ये standard design होते हैं, कैसे how they drafted, how they prepare, and what is meant by corporate governance, and it describes the duties responsibility of company directors. What are their company directors duty responsibility according to conceptual framework हम देखेंगे. So regulatory framework है, इसमें फाइनेंशियल स्टेटमेंट बनाई जाती है, नेशनल स्टैंडर्ड एंड रेगुलेटरी इंटरनेशनल अकाउंटिंग स्टैंडर्ड IFRS के अंडर, and then corporate governance is how they manage and run the business, ownership versus control, and purpose and objectives. So ये है objective of the overview of the chapter, and keep reading their headings and their exam point of view. So because I will show you complete the chapter, so we'll not skip any part, so we'll help you. So if I pass it on, you can go through in detail. Regulatory framework, again, they ensure the need of the user of financial statement met with the basic minimum information, and to ensure that information provided is relevant to economic area and both comparable and consistent. So this is the main purpose of framework, regulatory framework, to increase the user's confidence and to regulate behavior of the directors towards their investors. So national regulatory framework for financial reporting is a national financial reporting standard, national law, a market regulation, and security exchange. If any country, if the whoever is following in any country like Dubai, they have some IFRS standard they follow, plus they follow a national financial reporting standard. Their government, local government, their law follow the national law. Their Ministry of Finance, they follow any licensing department involved, so they follow their market regulation. They follow and abide by their all security exchange rules. So they have to follow not only IFRS, they have to follow many other regulatory framework or regulatory environmental or the structure they have to understand and they have to follow. For the ACCA is UK based, and here they have explained if the US companies are there, they will follow the Sarbanes-Oxley Act according to their USA point of view. If any country in a company working in Europe, they follow the European contracts, European structure, or if it is in Pakistan or other India or UAE, so they follow their as well as IFRS, plus they follow their country's regulation, IFRS accounting standard. So this is the reason they have a prepared accounting standard, international financial reporting standard, to make a harmonization. The harmonization means if you are following IFRS in USA or India and Pakistan or Dubai, so you have branches in all over the countries. So you follow the same way of presentation, mean harmonization. So this is the example of harmonization. The importance of harmonization: do some research on the internal of words that have totally different meaning in the different countries. When you have done this, you will undoubtedly have a much better appreciation of the harmonized approach. Mean they follow their government rules, each country's rule as well, plus they follow the IFRS for the harmonized accounting treatment. So this is the meaning of this one. The structure of regulatory framework. IFRS Foundation, International ISB is there. So remember, this is the you are going to interact all these departments in more detail in upcoming lectures and upcoming subjects as well. IFRS Foundation. IFRS Foundation. What is the foundation? Is a foundation is the supervisory body of ISB. Student, this is the interesting part. Just to go through. So you will have because there are the multiple choice question also coming from this area. So they will test you about your understanding. International Accounting Standard Board. So what is stand for and what they are doing. IFRIC interpretations are also there. International Accounting Standard is there. You have to understand what is this meaning. What is IFRS Advisory Council? What are their functions? Development of IFRS standard. So the procedure of development of IFRS standard is as follows. First, just to understand, so it will whole clear concept will be clear. Board identify the subject and appoints advisory committee. The board published an exposure draft to public comment being drafted version of the intended standards. This is the way how they start. So this is board publish an exposure draft mean just a draft about the suppose it's a new concept when was designed as a leasing concept. So they make exposure draft and for a public comment. So they just ask opinion from other audit firms and companies and their stakeholders and the users of this information. So then they start a discussion debate on this. It takes years to become a standard. So following the consideration of comments received on draft of the board publishes as a next text is the standard. So at any stage, the board may issue a discussion paper to encourage comment. Discussion paper you will see. So in advanced papers, so this is a way discussion paper. Whenever you see, it means it's a debate paper or the further clarification on this one. So publication of IFRS standard exposure draft or IFRS interpretation require vote at least 15 of the board members. So this is the way how it is complete. Internationally, a sustainability standard board, ISSB. Student, this one you just go through. So this will help you for the clarification of this thing. This is the company ownership shareholder delegation of control to the director, your employees, finance director, marketing director, so on. They control the company and they control the objective. And the shareholder, they have ownership and they have objective to run the business to get a profit maximization of their earnings. External auditors, this is the auditor who are appointed by the company. They are external, mean they are outside. They are not in company's employee, so they are independent auditor. Current financial environment. What is the corporate governance? So this is the corporate governance is a provided useful definition. The system by which companies are directed and controlled. So directed control by the company and how the directed by the shareholder or management of the company, owner of the company, chairman of the company. An appropriate expansion definition might include it in the interest of shareholder and the relation to those stakeholders beyond company's boundary. So this is the meaning of the corporate governance. Purpose and objective of corporate governance. The basic purpose of corporate governance to monitor those parties within the company who control the resources and assets of the owners. So this is the main purpose of the corporate governance. So corporate governance. So these are the purposes and these are the objectives. Primary purpose, primary objective. This is a supporting. So this is easy way, just a self-explanatory. This is not a technical things. Need a corporate governance. So why the company require a corporate governance? Because they need effective management, effective system of internal control, oversight of management, fair appraisals, fair remuneration, fair financial reporting, and constructive relationship with the shareholders. Regulatory framework, students, just go through. These are the reading part. Just you have a chapter 2, and then we move on to main bookkeeping chapter. Chapter 3, student, for F1. This is a double entry bookkeeping. Always remember every transaction in accounting concept, accounting principle, each transaction have a debit and a credit. So this is a simple way. So you have to remember every transaction have a debit and every transaction have a credit. If the cash is coming, so what is the debit? What is the credit? Cash going, what is debit? What is credit? If it is a sale, so what is debit? What is credit? We will go through all these things now. And there are some rules, are simple standard rules I give you. We just remember those one. It will solve your 70% problem. Upon completion, this chapter explain the main four forms of business transaction, understand the concept, double entry system, bookkeeping, and identify, explain the understanding the form of accounting records and source documents, how it is maintained, all these things. Transaction occur. So source of documents, quality and accounting equation, and then financial statement, and how this is a source document in accounting system it affect, and how this is a cloud computing it will affect. This chapter introduce you to a nature of business transaction. Go through this one. So these terms, what is the purchase order, sales order? So when you buy some item, so they issue a purchase order. When you have a sales order, dispatch note, what is GDN? So this is one also important. GRN, good received note, good dispatch note, and sales invoices. These are the basic terms which you need to. Now you are just starting phase, and just to see purchase invoice and supplier statement. What is this one? And credit note, when you have some refunds from the company. So there is a credit note. When you have a debit note, so when you detail of supplier containing detail of goods returns or some details are there. Remittance advice. So important, basic things, students. You just will understand by reading this thing. Explain the dual effect of the transaction. Let's see all this transaction. The sole trader has paid 10,000 into a business bank account. The dual effect. The business has a cash at bank 10,000, and the business owned proprietor the return of 10,000 equity capital. Okay. So Lee paid rent 1,000 and the business premises. So expenses incurred is 1,000 and cash bank decrease 1,000. So mean debit is the expense and the credit is there your bank account. So bank account or cash or whatever. So expense in other way, the simple rule, expenses always debit. Expenses always debit. Remember, expenses, whatever expenses, whatever approved expenses, always debit. Either credit will be bank or cash or whatever you are paying. So lead purchase goods to resale, paying 25 immediately. The dual effect. The purchases expenses incurred by 2,500 and cash decreases 2,500. Lead purchase, as I said, expenses always debit. So this is the debit formula is applicable here. They sold some goods. So now again remember the rule one of for your life. The rule two, the Sales always credit. Sales increased by sales always credit. This is a rule. Receivable or that cash is a debit. If this is a cash sale, this is a cash is debit or bank is debit, and sale is a credit. A sale always credit. So this is rule number 2. Whenever you find a sale entry, sale will credit, debit you find out, receivable will debit or bank account will debit. Accounting equations, assets and equity, assets is equal to equity plus liability. Asset is equal to equity plus liability, or asset minus liability is equal to equity. So this rule you have to remember. So when you practically make a calculation, so it will be clear your concept when you see the balance sheet. So equity means shareholder equity plus liability. If you total up all these investment wherever it is going, wherever it is invested, it means this is a total will come as an asset. Asset and liabilities figures always match up and tally. The both figures will be always tally. So double entry system illustration, so they have mentioned. So we'll see for you to clear your concept. Commence the business with the introduction of 1,000 cash. The startup equity is 1,000, paid rent 350, and then purchase delivery van 400, obtain a bank loan, purchase goods resale at cost 300, sold all goods purchased 400, credited. Okay, so this is a way of the examples, the answers. How all what was required? Use the accounting equation of illustrated position of Ali's balance in each transaction. So see what how this is a commencement of the business. Starting is 100, 1,000 is the asset. P is the entity owns 1,000 minus the capital. So the assets will be 1,000, equity 1,000 plus liability is a 0, which means the total will match up. Ali paid 350 as a rent. So 350 asset from assets it reduced 350, and equity also it reduced 350 from its investment. Purchase delivery van. Purchase delivery van. This is a way of the payment which it affect the assets, and then equity will also be affected. Obtain 1,000 bank loan, so they it increase assets by cash is a bank loan increase, and liabilities they have equity plus liabilities. So this is a way how it is we have in the beginning we have discussed. So equity plus liability is equal to the assets. So this is the way how it is presented. Then sold goods, good sale entry will also be helpful for you. So in the dual effect of the transaction, so the dual effect, so debit credit. So what is the purchase debit credit entries are there? This effect will be coming over here. All a transaction will be showing over here. Dual effect, purchase for cash, increase inventory, decrease cash. So this is a dual effect. Purchase on credit, increase inventory, increase payable liability. Cash sales, making profit, increase cash, decrease inventory, or increase equity. So these are dual effects rules you have to remember. Increase cash, bank loan, obtain bank loan. Of course, bank when approve a loan, it will increase your cash and it will increase your liability. Bank payment of wages, decrease cash, decrease equity. Bank interest received, increase cash, increase equity. So bank interest received. So they focus on the point. So bank received from credit note. So increase cash, decrease. And bank payment, how it is affecting all the decrease in cash and decrease in the liability. So double entry bookkeeping system transaction, when transaction occur, effects of records and ledger accounts, balanced off and trial balance. So we'll bringing it to you to the trial balance, and then for the financial statements are created. First, journal entries are maintained. After journal entries, debit credit when complete. So then after that, the summary of all these totals are bring into the trial balance. So like payable expenses are there, or the rent is there, or the any expenses, vehicle maintenance, total all last month end total or year end total will be taken into consideration as a debit, and then credit will be mentioned of this transaction. So after this trial balance will come into the year-end adjustment from the ledger, and then financial statements are prepared. So depending upon the nature of transaction, data recorded is likely to include transaction date, nature of transaction, product quality and quantity, monetary values, rate, and early settlement discounts, if any. Accounting system, which accounting systems are there? Input, source, documents, data, input, accounting system, calculation, ledgers. This is the way. Output is a trial balance, and the reports are the output. So these things are input. So whatever transaction, basic transaction are happening. So source documents like the payroll, petty cash, summaries, bank summaries, and journals set as standing data, the repeatedly assisted the process of the recurring or regular expenses. These all things should be taken into processes, how it is processed, transaction, recording transaction, which may be done in the real time. So updating take place in the transaction where batch processing are appropriate, intervals are involved. Calculating, classifying of summarizing data, and updating journal ledgers. So all transactions. So we are discussing in terms of manual recording and the computerized recording, but that is not a fact. But sometime manual computerized recording, but you just put one entry and second effect, it automatically take care. And output is just a trial balance of financial statement extract which are required, and the report which are generating the analysis of these reports. Useful accounting information. So individual receivable ledgers. So how much receivable from party A, party B, individual reports are available. Individual payable also there. How much is you have to pay party X, Z, Z, any ABC, XY. Inventory usage report also there. How many items are purchased and how many sold, and this is all there. Prepare analysis are also there. So these basic things are taken into consideration. For the purpose of ACCA syllabus, the exam is assumed that as a transaction are processed and up-to-date general ledger and memorandum, only accounting information is updated simultaneously. Consequently, this means that when memorandum only accounting information are recorded, it will match exactly the information recorded. So this is your learning purpose. They have mentioned development of accounting system, how the system is developed and it take off into the advanced stages. This is your reading part. How the inventory is management and the human resources, the payroll operations, double entry bookkeeping, it should could computing and cold accounting, cloud computing. This is a definition of cloud computing and cloud accounting. This is a system of the transaction of computing system in the process is there. So this is the advantage of cloud accounting. So the entity does not have to pay for install, manage, and protect software, individual machines, capacity of cloud store more data of share is they have to pay and they get these services. So disaster recovery disadvantages entry reliant on the financial information. Could service provider be exchanged? Ensure reliant information, ledger account and division on the general ledgers. So what is the definition of general ledger? The ledger account. A term of general ledger is used to refer to as a complete set of ledger accounts used in entity record transaction. It may also be referred to as a nominal ledger or chart of account. It forms this definition, student. You need to remember for exam point of view. So your whole this chapter and whole book even you is clarifying you concept. So you just remember it when they ask in objective type. So you are sure and you make a right tick. Ledger account contain transaction assigned to specific asset, liability, and item of the equity, revenue, and expenses. Debits and credits. This is a T account which I show you. It shows the debits and it shows the credits, purchases, wages, name of the account, whatever is the name, the date, narration, details, dollar amount. So this column you have to prepare. This is also called a T account. So dual concept, debit, increased expenses, asset, drawing dividends, consequently a decrease in this much and decrease in liability, and credit liability, income and capital equity. Okay, students, these rules you need to memorize and follow and understand. Summary of steps of recording. Determine the individual ledger account of the effect. Consider whether each account balance is being increased or decreased. Decide which account should be debited or credited. Check that the debit and credit entry have made for the same monetary amount of the entities. In the ACC exam, you may be presented the accounting information presented in form of a T account and be asked to complete it for the identify the rectifying missing and risk contract information. So if some information or some part is missing, so they will test your understanding how you are aware about these things. Using the information form of earlier illustration, so they said they just to bring a debit credit of this is the way how you make a debit credit in the ledger books. Okay, students. This is the solutions. So purchases for cash, purchase debit, cash or bank credit. So purchases on credit, purchases debit. As I said, expense is debit, payable is a credit. Cash sales, cash is a debit, sale is a credit, always credit. Cash sale on credit sale, receivable debit, sale credit. Okay. So this is always a credit, sale always credit, purchase is always debit. This rule. Obtain a bank loan. So cash at bank and then loan liability, bank payment, wages and cash. Again, wages expenses is a debit and cash is a credit. Bank interest and this is bank receipt from creditor and then payables are there. The journal entries. So how what the journal entry record of accounting transaction for the routine transaction purpose. Example of transaction of journal entries include irrevocable debt written off, adjustment, approvals, depreciation, acquisition, and closing inventories and correction errors. If any entry which is not part of this one, so it will consider in the journal entry is prepared and maintained for this purpose. This is example of journal entries. Journal entry or journal adjustment. Adjustments are those adjustments which are required to adjust as it is not a part of a routine part of this thing. Mind to say is a irrecoverable debt written off. Irrevocable debt which is not recoverable. It is a sure party is out of screen and is bankrupt or something. You just may pass a journal entry for this one. So debit in recoverable debt and credit is a receivable. Whatever if party X is a bankrupt, so you will make a receivable of X account will be reduced then. These are the test your understanding, balancing and closing ledger. So when whatever is the total amount is there, that is called a closing ledger. The procedure to strike out journal ledger balance is as follow: total both side, and then inside the larger total box in the box debit and credit side. Insert the balancing figure, carry the balance forward to the other period, which is the carry forward or brought down. Like this one, cash at bank, capital this month, sales is this much, purchases, and then this is the total up. And after that, whatever is the amount is a carry forward, it is carry forward to this next period. Cash at bank, again, this is a total, and then whatever is at 9825 is a balancing figure, so it will be bring up here. Profit and loss in ledger account at the end of each period. After closing the period, that after when we finish a trial balance, then it shall come to this point for the for the profit and loss account and statement of financial position is maintained. So these are practice questions student will do in the revisions. So definitely we will start a revision, but see the chapter summary. Transaction occur for payable, receipts, payments, and what is the source of documents and how it is done over accounting system. And then the duality of the accounting concept, and then financial statements, cloud computing, and accounting. This is also important. This is nowadays practice, and examiner may test you in this area. So students, so now let's go to this slide for our flashcards, which is committed to show you. These are the flashcards for chapter 2. This is a bookkeeping concept. So double entry system. The double entry checklist is there. Transaction debit and credit, how purchase debit and credit note, and the sales debit credit cash sales. Trial balance, this is a template of trial balances also, and the record of transaction. So we'll see you in the next chapter student. Study hard, and wish you all the best. See you next chapter.